It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of A Bank in Formation. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show, and today, folks, I'm really excited. We've got a special guest, but what I want to say first is, if you listen to the last show, I was sharing. This is a continuation of the last show, where trying to answer the number one question I'm getting from listeners and prospects and even my clients is, in this tough economic environment with the high inflation and everything else that's going on, where can I invest money with a reasonable rate of return and expect some sort of expectation of not losing it? So I've been sharing, like I said, the personal bank concept is one of those places. Obviously, if you've been listening to the show, you know, to get the positive arbitrage. I have shared I-bonds as another place to consider. You can go to treasurydirect.gov. It's paying 9.6% right now. That's not a bad option. But I've got a third option here that I'm going to share with you. And again, before I do, I'm totally agnostic. If you listen to this show, you know it. I don't care where people invest their money. If you've got something that works, keep doing it. So I'm not saying it. I don't want you to do this because Ference said so. What I want you to do is look into it, do your due diligence, and you determine if this is something that's for you. I find it interesting, and full disclosure, I fully plan to invest myself. So again, I think it's an interesting idea that you should consider and look into. And our guest today we have is Lane. And Lane, you're going to have to pronounce your last name for me.
It's Lane Schoenberger.
Okay, he's with YRefi. And Lane, what is your role or position with them?
I am the Chief Investment Officer and one of the managing members.
All right, well, welcome to the show.
Thank you. Pleasure to be here. Thank you for having me.
So the first question I've got to ask you, Lane, is what is YRefi?
YRefi. We are in the business of refinancing distressed private student loans. We do not do any federal student loans, strictly private and strictly distressed.
Now, that's really important. I think you mentioned the private, because there's been a lot of news about the Biden administration potentially forgiving student loan debt. But this would not affect this at all. And why is that?
Correct. So there's two types of student loans. There's federal and there's private. Okay. All student loans are bankruptcy protected. So this is not an asset that the borrower can just wander into a bankruptcy court and say, hey, I can't do this, I need out. Getting out of a student loan through bankruptcy is nearly impossible. So with that, there's two sides. You got the federal and the private. On the federal side, these are backed by the federal government, backed by the taxpayers to 97 cents on the dollar approximately. And the federal government has all kinds of programs on how to push your payment into forbearance and defer payments and through income-driven repayment plans and so forth. Private lenders, on the other hand, they don't offer any of these programs. Private lenders are banks. Okay, for example, Wells Fargo, just to name an example, Citizens Bank. These are funded by private investors, and in essence, the borrower borrows that money to go to school. And when they come out of school, it's time to start making payments, and that's where YRefi steps in when they can't make those payments.
So you basically purchase distressed student loans.
Correct. We're buying them and we buy them at a discount, and we help restructure that loan, refinance it into a new loan that the borrower can actually afford to pay. We put the borrower through a very rigorous underwriting process, allowing them the opportunity to prove to us that they have the willingness and ability to pay us back. We then put them into a custom loan that they can actually afford. Fast forward, here we are 5.5 years in, and our borrowers are wildly successful. We have a very, very low default rate, less than 2%, and our borrowers are performing well beyond our expectations. So we're very, very happy for them.
So when you bring a borrower on, you in essence rehabilitate their credit and their ability to repay.
We do. Yeah. So interesting thing, Ference,
Yes.
about these borrowers. When they come to us, and this is to some degree a part of the socially responsible aspect, if you will, of this opportunity, is a borrower, when they come to us, they generally don't have a lot of other credit. Okay, and the student loan has done some really bad things to their credit. They don't own homes. They don't have credit cards. If they do, they're minimal. They don't own cars. If they do, the car loans are small. And their credit scores have just been decimated. Our average borrower comes to us with a low 500, high 400 FICO score.
That's tough.
Okay. Our average co-borrower comes to us with a low 600, high 500 FICO score. Now, YRefi, we didn't start this business with the intention of repairing credit. What we
Right.
discovered is through an unintentional benefit, the way we do, what we tend to see is about a 125-point FICO bump on a borrower in 6 to 9 months from us funding a loan, and about 138 on a co-borrower in that same time frame. Now, what's interesting about this is 70% of our portfolio, which is right in line with statistics on the total federal and private portfolios, is that 70% have co-borrowers. So mom, dad, grandma, grandpa, someone has signed on this loan with this borrower, and they're in the same trouble. Well, you see FICO score recoveries like that, and these are meaningful, impactful changes to these folks, okay? What I mean by that is
Sure.
FICO drives everything. Your
Right.
ability to buy a house, get a car, get a credit card. Even some insurance companies are FICO driven from their rate standpoint. So these are widespread changes across their financial horizon, right? It's meaningful to these folks. So that's kind of that socially responsible part,
That's really cool. So obviously you're purchasing these distressed student loans,
correct?
rehabilitating these situations so they get back on a payment schedule they can afford.
Right?
And then on the other side, obviously you're raising funds as a private investor.
Correct.
And that's why you're here on,
That's
on
why I'm here.
That's why your
That's why
Personal
we're
Bank
here.
show. And so if somebody's on the investor side and wants to take advantage of, or, allocate some money, because like I said, gosh, where can you invest your money these days with some relative safety?
Right.
How does it work with the investor side?
So YRefi, we've built our fourth portfolio. It's called YRefi SLP4. It stands for Student Loan Portfolio 4. This is what's called a Regulation D 506C. So it is filed with the Securities Exchange Commission. This is for accredited investors only. If anybody wants to know what an accredited investor is, you can tell them, I can tell them. Like, call
Right.
in and we'll explain it. In this portfolio, minimum investment is $50,000, and you can allocate that. I'll explain how you can allocate it.
Sure.
And the way it works very simply is the investor comes in and they can pick the duration of their investment from 1 to 5 years. Okay, so I always use the example of a client putting in, say, $500,000.
Okay.
Put $100,000 in the 1 year. That's paying 6.25% fixed interest. Okay.
Okay.
Put $100,000 in the 2-year note. That's paying 6.75% fixed interest. A 3-year note, 7.5. A 4-year is paying 8.25, and a 5-year note is paying 10.25% per year fixed interest. Okay. So the way this initially was designed, client says, I want to put $100,000 into each note as an example. Okay. Again, minimum's only 50, but just go with it. So
Now that minimum is total of 50, correct?
total of 50.
Got
You
it.
could take 50 and put 10 into each if you wanted to.
Okay.
Okay. We actually have a client that has done that recently.
Okay.
So anyway, so you put that money in, and the initial design was that you have, as the investor, the ability to take interest income only every month, and at the end of the term, you get your money back. It's structured very similar to a bond.
Right.
Okay, they're promissory notes. Structured, the structure just looks and feels like a bond. So with that, client takes that interest income, and at the end of the term, they get their money back, or they can then roll that money up the ladder if they chose to do so. This is an opportunity for a client to create a laddered income.
Okay.
Then we said, let's get really creative with this. Okay, let's allow the opportunity for the investor to, maybe they don't want the income. Maybe they want to compound or reinvest.
Right.
So we said, all right, let's give them the ability to go into each individual tranche and turn it from income to compounding. Let's take it one step further. Let's give that investor the ability to turn income up or down in 1% increments in each individual tranche as often as monthly. So you've got maximum flexibility.
Okay.
So I use this example. You got that 100,000 in each tranche. Client says, I need income from the 1, 3, and 5 year note. I want to compound or reinvest the 2 and the 4-year note.
Okay.
Okay. Next month they come along. They say, I need a little bit more income. So they say, I want to take it from the 1, the 3, and the 5. I'll take 52% of the income from the 2-year note and compound the balance, and I want to compound the 4-year. Great, we can do that.
So you could get really creative with
Very
this.
creative, complete and total control by the investor. Okay. Then they come in the next month and they say, I don't want any income. Turn it all off. Let it all reinvest.
Okay.
Okay. So you've got complete and total control. Now I'm going to pick on some other products. There's products out there, and you can agree or disagree. Annuities, for example, if you turn on income in a fixed income, or any annuity, frankly, where you do it in an income rider or you annuitize, that's chipped in stone, signed in blood. You're not changing that. I don't know of any annuities where you can turn it on and off, up and down, and do all these things. Maybe there's some out there now.
Well, is
there some?
Yeah, they're bringing you up to speed a little
Please.
bit because you used to be in that business some years ago.
Some years ago.
You can turn it on and off.
Okay.
At any time you want, but they don't go up or down.
Okay.
So
they don't
whatever
go
the
up or
rate
down.
is, the rate is the rate.
Got it.
Okay.
Okay, so they do have them now where you can actually turn them off.
Yes,
and,
so
okay.
that part they have.
Okay, good to know. Good to know. Glad to hear that, actually.
Yeah. Yes. It's
so
a relatively recent
fair
improvement.
enough. No, that is an improvement, actually. I'm glad to
is.
hear that.
Yes.
Now, if you annuitize, you can't change it.
That's different.
Okay.
Right. Annuitize, yeah, exactly. Like you said.
Only if it's an income rider.
Yes.
Got it.
If it's an income rider, we don't typically recommend annuitizing because you lock yourself in stone. Period. That's
Right.
it. Just like Social Security, once you turn it on and you set it, that's
Set
it.
in stone. Right.
It ain't changing.
Gotcha.
That's correct.
So we've built this very, very flexible structure.
Yes.
And given the investor the flexibility, and then in July our new investor portal is coming out, where the investor can actually go right online. They can run cash simulations. They can make these elections. Everything will be done right in the portal. So again, maximum flexibility with a click of a button.
What would cause somebody not to go? Because you mentioned the rates are anywhere from 1 to 5 year terms, and 6 1/4 up to 10 1/4.
Correct.
What would stop somebody from saying, look, I just want to put it all in the 5 year, and I may or may not turn income on or off as needed?
We have a lot of clients that do that. They just go straight to, for example, the 5 year.
Right.
Put 100,000, 200, whatever their number,
Right.
into that 5 year note.
At least 50, right?
Yep. Our 5 year note is actually our most popular.
Well, it's 10.25%, I understand.
Great. Followed by the 3, I believe I'm going on memory right now,
Yeah.
the 2, the 1, and then the 4
Okay.
in that order. And so the answer is yes, you can pick one. You don't have to spread it out amongst all of them. It's just an option.
Sure. So, Lane, if somebody was interested in more information on this, how would they contact you?
Well, they can go to Invest Y Refi. It's just invest, the letter Y, REFY.com. Or you can call the investor relations team, or you can call me right on my cell phone. I'm going to give that number out, believe it or not.
What's the-
602-292-6287.
What is that again?
602-292-6287.
And do us all a favor, folks. If you do call Lane or reach out to him email, please let him know that you heard him on the Your Personal Bank show, because we always we all want to know where we're getting
Absolutely.
folks who are interested from. And then we're going to talk about in the next segment, I'm really going to encourage you to stay tuned, because as good as this can be, well, if you combine this with the Your Personal Bank concept, folks, you can add a 2 or 3% positive arbitrage. So if you're getting a 6 1/4 to 10 1/4 rate return with the Y Refi, backed by student loan debt, you can add 2 or 3% to that.
Right.
So now we're looking at 8, 12, 13% returns with some, on the insurance side, guaranteed, with guarantees, tax-free also on top of it. And I think that stands up really, really strong compared to a lot of other things today. So stay tuned. Don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank show with Ference Toth.
Welcome back to the Your Personal Bank show, and we have a very interesting guest today, Lane Schonenberger. Schonberger. Apologize for that.
That's all right.
He with Y Refi, and he's talking about a very interesting and kind of unique investment opportunity, basically investing in private student loan debt.
Correct.
Now, Lane, if somebody missed it, can you give us a real quick, what is Y Refi? What do you do?
Y Refi refinances distressed private student loans only. No federal student loans, just private. So we're not subjected to any forgiveness. We didn't really dive too deep into that. Let's talk about it. But only private distressed student loans.
Okay, so since you brought that up, let's go there, because it's in the news. I mean, almost every week.
The political hot potato of the day.
Yeah, potentially Biden administration forgiving a bunch of student loans. If they did that, how would that affect this?
So it's a great question, and we get asked literally by almost every investor. And in the answer, there's two answers: the short and the long. The short answer is we are in private, not in federal. It's not their money to forgive. So we at Y Refi are not concerned about them offering any kind of forgiveness on the private portfolio, because they would actually have to write us a check for the amount of the portfolio in order to pay it off. That'd be like me saying, hey, Ference, guess what? Your mortgage, it's paid off. Mm-hmm. No one cares until I write that check.
Right.
Okay.
Right.
So there's that. Now, the longer version of that story is federal student loans again, they're backed by the federal government, taxpayers, it's on their shoulders. If they do any kind of forgiveness of federal loans, whether it's this 10,000 that they're talking about now or some other amount, most borrowers that have private loans also have federal loans. So what we would expect to see, and we've done a ton of research on this, and I actually have an article from the Office of Responsible Budgeting, which is a government agency, okay, where they've done this.
That's an oxymoron.
I know, right?
What was it? What'd you call that again? It was government.
The Office of Responsible Budgeting.
I didn't know that existed with the government.
No one does.
Okay, got it.
So, but it's a government agency, and what they've done is they've already done the homework. It's a 4 or 5 page article, and they're basically saying that the forgiveness of any federal student loan debt would just be a burden on the taxpayers, would accomplish zero, throw more towards the national deficit, would increase the cost of college inflation even higher than it already is. And at the end of the day, when they polled the borrowers, 100% of the borrowers said the freed up cash flow that we would see, which they estimated between $200 and $500 a month, those borrowers, all of them said one thing: we will use the money to pay down our other consumer debt, including our private student loans. So there's zero benefit to the government to do this. But the government doesn't listen to the government. They're going to do what they're going to do.
Well, the politicians don't, and playing devil's advocate, in my opinion,
right?
Again, this is my opinion, that Biden has kicked the can down the road to closer to the election so that he can buy votes.
Agreed. You and I are on the same page. Absolutely.
Exactly. So even though this budget office
right.
that recommends this, I do not believe that's going to be listened to.
I agree completely.
I think we're going to see unfortunately, I think we're going to see some kind of student loan forgiveness.
I agree. There will likely be a little bit of something just to get the votes and be able to say we did something. But
right.
that's a whole other conversation.
That's a political conversation.
The question then becomes, what does that do to YRefi?
Right.
What does that do to our portfolio, and how does it affect our investors? And
right.
the answer to the question very simply is, right now we are experiencing over 10% prepayment speed. What that means in our portfolio is a little over 10% of our borrowers are making an additional payment.
Okay.
Payment's $500 a month, and they're paying $525 or something more. They're paying something additional towards paying off that debt. And what we would expect to see with that freed up cash flow is that our prepayment speed would actually go up. Now, if you understand our model,
right.
prepayments are very, very good. And we love to do that. We want to see our borrowers succeed.
For the borrower, there's no prepayment penalty.
Absolutely not. No prepayment penalty.
Okay.
So now, one of the things that I wanted to mention about our portfolio, this is a secured, collateralized.
Now this is for the investor.
This is for the investor. Going back to the investor.
All right,
Thank you.
Let's go back there.
So this is a secured, collateralized portfolio. What does that mean? That means that there's a great big legal document that very simply says, in simple terms, if YRefi defaults on a payment to an investor, be it interest or principal, the portfolio is sent over to an independent third-party collateral agent. That collateral agent has one job. It's a math decision. Okay, they don't care about my feelings at this point. It's all about, how do we pay back these investors? What does that look like? Okay, we got to
right.
pay them back. Well, we sell the portfolio. Do we collect on the portfolio? Do we sell a portion and collect on the balance to pay back the investors? Okay, those are the options. It's a math decision, frankly. So
it's much like when FDIC takes over a bank.
Exactly.
Similar idea.
Same idea. And now the other side of that is, what's the asset? Well,
right.
the asset is a portfolio of bankruptcy protected student loans, okay, that have 70% have co-borrowers, and now becomes how leveraged is this asset for the benefit of the investors? So I'll give you an example. We settle the debt out in, let's call it 35, 38, 40 cents on the dollar, okay?
Okay.
We refinance that to the borrower and at 100%. Okay, we tack in our refinance fee, so we've got this nice spread in there.
Okay.
What we then do is we're giving this borrower a custom loan, a low fixed interest rate. Okay, our portfolio is only 3.9%. So these borrowers are not getting hit with these massive interest rates.
Right.
Okay, we then give them a custom term. Okay, average term in our portfolio is only 8.6 years. These are not predatory loans. They're very low fixed interest rates. They're custom terms, and they can afford the payment.
Okay.
That's why our default rate is so low. Well, then the other side of that is you've got the borrower making these payments. Sorry.
There you go.
Got to get back in that train of thought. It's been so good until just now.
It happens to all of us.
Yep.
The best of us.
Yep.
But go ahead. So, let me ask you while you're thinking on that. So you're talking about a low interest rate loan for the borrower, and you're not really going to be subject to the whims of the Federal Reserve and the rates and all that stuff, because you're getting the money from the private investors.
Correct.
And so basically you're able to dictate or be able to control the interest rates to the borrower. So if interest rates go up, which they're clearly doing,
Right.
the Federal Reserve's come out and said they're going to raise rates. Most people are expecting at least a half-point rate this month and another one next month at the
Right.
very least. But that's really not going to affect you and your borrowers that much, is it?
It doesn't affect them at all because
Right.
we dictate our own interest rates. We're a completely non-correlated asset, meaning
Right.
we're not correlated to any of the markets, the Fed, none of it. Okay.
And Lane, I got to say, that's one of the reasons why, and those of you that are listeners to the show know that I don't bring on a lot of financial people to the table or invite them because, we all know if you want to invest in the market, there's plenty of people to talk to.
Right.
If you want to invest in real estate, there's plenty of people to talk to. You want to buy precious metals, cryptocurrency, any of those other things, there's 100 people to talk to about any of those things. And we all know the pluses and minuses of those investments. We talk about them regularly.
Right.
This is something that's fairly unique.
Mm-hmm.
I find intriguing because, again, it's like you said, it's backed by private student loan debt that cannot be bankrupt.
Correct.
Can't be They can't get rid of it, discharged through bankruptcy court.
Right.
So there's some relative security or safety as a result.
Right.
Much like a real estate loan, it's backed by the value of the real estate. Right?
It is.
Yeah.
What's interesting, and I remember what I was going to say a minute ago.
Awesome.
So at this point in time, where I just said our average interest rate to our borrower is only 3.9%.
Right.
This is usually where most investors stop me and they say, Lane, how are you paying 10.25% on a 5-year note if you're only collecting 3.9 from a borrower on average? The math doesn't make sense.
I already know the answer, but
you know the answer. So the answer is, again, we're buying at a steep discount, refinancing at 100%,
Right.
plus our 5% refinance fee. So these borrowers there's about a 70-ish point spread in there.
Right.
Why Refi is not making its money on the interest that we're charging these borrowers. We're making it on the spread. We're sharing that spread.
Because you're buying distressed.
We buy it at
debt.
a discount, correct.
You're buying it at a discount.
Right. So we're sharing that spread with the investor to be able to do well by doing good in the industry and helping people.
Which we got to talk about. We're going to talk about in the next segment how you're able to do that and how much availability is there in that arena. So stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and today we've got a special guest, Lane Schoenberger with Why Refi. And one of the things we kind of got caught up on the last segment, Lane, how if somebody's interested in investing with Why Refi, which is you guys buy distressed private student loan debt, how would they contact you if they want more information?
Visit investwhyrefi.com. That's just invest, the letter Y, REFY.com.
Okay, excellent.
Or you can call me.
Absolutely. And what's the number?
602-292-6287.
Again.
602-292-6287.
One of the questions we kind of finished up on was how do you get the borrowers?
So, great question. How do we get the borrowers? Why Refi does not do any outbound phone calls. We are not those robocalls that you get. That is not Why Refi. We actually get our borrowers one of 3 ways. Okay, we work with directly with the lenders, servicers, collection agencies, and law firms. We've established over 120 some relationships with these folks, and they will actually transfer the borrower live from their call floor to our call floor and hand them off. The second thing we do is pay-per-click. There might be certain keywords a borrower would be on the internet typing in looking for help, and they would be directed to Why Refi. And the last thing we do is we actually work with the credit unions.
Collection agencies.
No,
right?
the credit reporting agencies.
Oh, credit reporting.
Wow.
Okay.
The credit reporting agencies.
Okay.
TransUnion, Experian, Equifax, and
Right.
what we do there is we query data. We know who the borrowers are that have the problem we built the solution for, and we would send them basically a postcard. It says, hey, you've got a problem, we've got a solution, here's our number, give us a call.
So
everything is inbound.
So how does it go in terms of like finding the borrowers? How are you doing in that arena?
I know it's going very well, particularly since August. We had a 66% spike in call volume in August. And I'll give you the quick background on that. There was all that student loan forbearance that was going on with the federal government.
Right.
That did flow over into the private arena just a little, in that when they did this, what you don't hear behind the scenes is the federal government went to the private lenders who all have relationships with the Department of Education and said, you need to put everybody in forbearance. Well, the private lenders said, we can't do that. We have investors to pay. Here's our compromise. We'll stop collecting on the people that are in this portion of the pipeline. If they're this far down, we're going to keep going after them. If they're current, we're going to leave them paying. They have to call us. But if they call and sniffle into the phone and say the word COVID, we'll put them into forbearance, but they have to call. Well, that was the agreement.
Okay.
So that went on for 18 months, and that was where we saw probably the biggest strain on the business. All right,
Sure.
because now the leads dry up. I shouldn't say dry up. They went
Slow down.
They went slow down. They went flat. Okay.
Okay.
Bring in $500,000 in apps, you fund $500,000 in apps, and it was very stagnant for 18 months. Well, in August, if you go back and you listen to President Biden's speech, where he's talking about extending student loan forbearance into December, he made it clear in that speech that that is for federal student loans only, not your private student loans. Well, in August, we saw a 66% increase in call volume.
Right.
Because all these private lenders were hiring collectors again, and they're making those calls, reporting them as delinquent and defaulted. So all of a sudden, everything turned on. Well, that flow volume has continued. April was our largest volume of new applications in the history of the company. May was our largest funding month in the history of the company. We're going to see how June stacks up. We're only halfway through it, not quite.
I would anticipate that going forward, especially once Biden does make a final decision after sometime this summer, fall, then you're probably going to see an uptick then, because there'll be some resolution at that point. Finally.
Yeah, we'll see more. Though the uptick
Right.
is coming, and this is a massive market. It's a $21 billion market. Okay,
So finding borrowers is not a challenge.
there's not a challenge finding borrowers. There's plenty of them out there.
So how about on the investor side? Because you kind of got to balance the two, right?
Got to balance the two. So those are when I get asked a lot of time, what are the biggest risks? The biggest risks are, is there enough market? Yes, there is. It's a $21 billion market, and it all just unfroze. The other side is raising enough capital.
Right.
Because we are a company where we raise capital in order to do what we do. And with the economy the way it is, the interest rates that we're offering, inflation and everything else, we offer a very nice alternative investment for investors to consider, where they can put money in, get a fixed return, whether it be income or growth.
And what is the return rates? Or
Return
the range?
is 1 year 6.25%, all the way up to 5 years at 10.25%.
So you're looking at 6.25 to 10.25 return,
Yes, sir.
and that's backed by private student loan debt.
Correct.
And so it seems to me quite interesting diversification strategy,
Yes, thank you.
particularly if somebody's concerned about the markets, or maybe the real estate market, or
We have seen quite an uptick
Yes,
in
I'm sure.
investors in the last,
I bet you have.
let's call it 60 days. We've seen a huge influx of investor interest.
Well, as I started the show today, even with the number one question I'm receiving is, where's a place I can invest and receive some relative expectation of not losing money,
Right,
and get a decent return at the same time.
right.
And Lane, that's why I invited you to the show.
Well, thank you. I appreciate that. And what's interesting also, Ferris, is we continue to build this, is we've done qualified money and non-qualified money. So retirement accounts and non-retirement
I'm
accounts.
glad you brought that up, because on the next segment, we're going to talk about qualified and non-qualified monies and where this could be a good fit for you. Lane, how would they contact you real quick?
InvestYRefi.com. It's invest, the letter Y, REFY.com, or call me at 602-292-6287.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. And if you've been listening to today's show, it's been a very interesting one, because as if you listen to the show my last one, I was talking about the number one question I'm getting from folks, anybody I'm talking to today, is where can I invest money today, get a decent rate of return, and have some reasonable expectation of not losing it? We're in crazy times. I mean, the CPI just came out at recently at 8.6, the highest in 41 years. There's no question that is really taking a toll on the stock markets. A lot of people, what the Federal Reserve is talking about they've raised rates now a couple of times. They're talking about raising half points at least for the next. We're hearing rumors of half-point raises throughout the rest of the year. Folks, if that happens, that's just going to kill real estate values. And so a lot of people are concerned about that. Cryptocurrency has not turned out to be the panacea that people thought, or they were claiming it would be, because it seems like every time the market goes down, if Tesla goes down, so does Bitcoin. And and then even precious metals, I get asked about that one a lot. And if you look at the charts, like gold, for example, has just not, you would think gold would be soaring right now, but it's not. And the reasons, it took me a long time to figure this out, but many of my banking friends have shared with me that about 80% of the world's gold supply is controlled by the central banks of the world. And so if you control 80%, you control the price. And it's no secret that the central banks manipulate prices on precious metals. So it's a quandary. Where do you put money today? Your personal bank, of course, with the guarantees and safety that's inherent to that. Positive arbitrage has been a very good solution. I've shared I bonds, inflation bonds. Go to treasurydirect.gov if you want more information on that. Unfortunately, it's limited. You can only do $10,000 per year per person, family member. The third option that I introduced, and we have Lane here with us today to share more about, is investing in basically distressed private student loans. So Lane, thank you for coming in today to Your Personal Bank Show.
Thank you.
So if somebody wants to contact you for more information, and again, folks, I want to say this, as I stated at the beginning of the show, I want to reiterate this. I'm not telling you to go invest in this. I'm telling you to check it out. I think it's an interesting option. So don't buy this because Ference said so. You want to do your own due diligence. And so, Lane, where would they contact you for more information?
Start with Invest Y Refi. So it's invest, the letter Y, REFY.com. Or you can call me on 602-292-6287. And, we're not here to sell. We're here to explain. We love to tell our story,
right?
Answer questions. If you love it, great. If you don't, I made a new friend. I'm good with that. I actually enjoy just sharing the story.
He's an educator at heart.
Yes, sir.
That's kind of my heart. But Y Refi, if somebody missed it, what is Y Refi?
Y Refi, we're a distressed assets company. All we deal with is distressed private student loans. So we're very specialized.
All right. And so you rehabilitate student loans for borrowers, private ones, not the public.
Correct. No federal.
No federal. So that way they're not going to be forgiven by the Biden administration.
Correct.
Okay. And if somebody wanted to invest, what's the rates of return they could reasonably expect?
A 1-year note for 6.25% up to a 5-year note at 10.25%.
That's excellent. Now, you can do qualified and or non-qualified.
You can actually invest in a qualified account. We have to work with a IRA custodian that will handle alternative investments, and we've got a list of over a dozen IRA custodians that we work with currently. And you can also invest in a non-qualified account. We can hold title as an individual, joint, trust, LLC, whatever format best suits your needs.
Sure.
One key is it has to be accredited investor. Only
Right.
accredited investors.
Got it. So one of the questions I get all the time is, can I take my IRA 401k and invest in the personal bank concept? The challenge is, the answer is yes with a caveat. The challenge is you can take money from it, but there's tax implications. There are certain strategies that can help alleviate that. Many people are familiar with Roth conversions, a similar concept as that. It can be done, but you're dealing with tax consequences. So my thought is, particularly on a qualified plan, this could be an interesting place to roll it over.
Mm-hmm.
No tax consequence in that regard then.
Correct.
And now somebody could create a 6.25% to 10.25% rate of return
Right.
on monies backed by student loan debt.
Right. And one of the questions we get asked is, what are the tax consequences for what we're doing here?
Right.
Okay.
True.
These are promissory notes.
Okay.
So we on non-qualified money, at the end of each year, whether you compound or whether you take the income, we have to send a 1099 interest form.
Sure, just like most non-qualified accounts. And if you're not familiar with that, that's your standard, regular, basic type of accounts. If you have a gain, you have to pay the tax on the gain. So
Right.
that would fit in the same realm.
Right.
If it's an IRA,
If it's an IRA, it's tax deferred.
right?
Under the IRA rules.
Right.
So if you're taking income, we're sending the payment back to the IRA custodian, and then you're taking the income from them and reporting the taxes however that IRA is going to treat it.
So it'd be no different that if you already had a non-qualified account, IRA, 401k type of account, the tax consequence is going to be exactly the same.
Correct.
You could defer it each year, not pay any tax. If you take money from it, you're going to pay the tax on what you took out.
Correct. Yep.
Nothing changes.
Nothing changes.
So, again, I consider this an interesting diversification strategy.
Thank you.
A lot of people are looking for that these days.
Yes, indeed.
So that's why I'm bringing this to folks' attention. So I do my intention here is, and I want to understand. I don't get really. There's not any benefit to this for me.
Sure.
I just think this is a good idea for somebody to explore and consider as an option. So that's why I invited you, Lane, today. So let's talk about this again, because these are some of the common questions. Is this a security?
It is a security under Reg D, Regulation D 506C, so it is filed with the Securities Exchange Commission. You can go there and look up our EDGAR filing. It's considered an exempt security under that specific rule. But yes, it is a security and it is filed.
How's the money protected?
Money's protected in a secured, collateralized portfolio. So the assets are backed by the portfolio itself. And there's a collateral agent and a security agreement protecting the investor in the event we were to default.
Okay. And what does that mean to somebody that doesn't know what that means?
In
English.
In English. It means if we default, the portfolio goes to a independent third-party collateral agent. Their job is to make the investors whole. And how do they do that? They take the portfolio and they either sell it, they might collect on it to pay the investors, or they sell a portion and collect on the balance. So let me give you an example of how leveraged that is in the favor of the investors.
Okay.
Investor puts $100,000 in. We turn around and we buy student loans, refinance them into new portfolio. Let's call it 2.5 to 1. Let's be conservative. Call it 2.5 to 1.
Okay.
So 100,000 is now worth $250,000 in face value. Okay. And I'm going to keep the portfolio small for the moment. We default, on our payments, and the collateral agent would then take that asset was worth $250,000 and sell it. Mm-hmm. Well, they're going to go out and they're going to sell it on the open market, and there's a very active market for portfolios that are performing.
Sure.
So they would sell that, let's say, 85 cents on the dollar.
Okay.
On the $250,000.
So it's still far more than what the investor invested.
Exactly, far more than what the investors invested. So now the investor's been made whole. So it's leveraged heavily in the favor of the investors.
And I would assume, Lane, I didn't ask you. I'm going to put him on the spot here. So I would assume there's some sort of accounting or whatever that you could provide to
we
documentation.
Do, yeah. All that. We are audited regularly.
I imagine so.
Yeah, we actually do that for a lot of different reasons.
Sure.
If ever we decide we want to sell a portfolio, those audits are going to be very important to a potential buyer.
So these are third-party independent audits. Independent
third-party audits. In fact, this new portfolio, SLP4, will be audited by what's called a PCAOB auditing firm. So they're on the other end of the spectrum from the standpoint of the quality of the firm. They're not just a CPA. They're on that higher level. Does that make sense?
Yeah.
I don't want to go into what a PCAOB is right now because it's a long story.
That's a lot. So the other part, I think there's some protection involved here. Again, is student loan debt cannot be bankrupted.
Correct.
By the borrower.
Right. So one of the questions that we get asked frequently is, well, what happens if Congress changes the bankruptcy laws? How is my money protected? And the answer is very simply this. We put our borrowers through a very rigorous underwriting process on the front end, part of which is we require that borrower to escrow, making a minimum of 2 months payment. We average about 6 while we underwrite. That's to have that borrower prove to us that they have the willingness and ability to pay us back. This is before we ever spend any investor money to fund a loan. So if for whatever reason the borrower fails or we decide not to approve them the underwriting process, there's zero risk to the borrower. Give them back 100% of their money. Okay. On the other side, we get them approved. They go through loan committee, they get approved, and we then take 100% of that escrow amount and we apply it on their very first statement towards principal reduction. So right out of the gate, they can see they're winning. Okay. So we're giving them that encouragement right out of the front. So with that, now the borrower is in the program. They're making their payments. They've actually made them for, let's call it 6 months, because that's our average right now. What we call infant mortality, where the borrower would typically default. That's usually in the first 12-ish months. In a lot of cases, we're halfway through that before we even fund a loan, because they've been making those payments before we ever even funded the loan. So they're off and running. With that, the borrower is now in the program. They're making their payments, maybe accelerating their payments, and they're winning.
That's awesome.
So going back to that bankruptcy part.
Yes.
So how do we protect the portfolio? The portfolio has got I'm going to give you some averages on our portfolio.
All right.
These are all of them combined, by the way, 1, 2, 3, and 4. So our average borrower indebtedness is just under $40,000. These are not massive loans. Okay, the average borrower interest rate is only 3.9 fixed. Custom term, average term is only 8.6 years. 70% of our borrowers come with a co-borrower, mom, dad, grandma, grandpa. So you get into a situation where they change the bankruptcy laws. Okay, borrower has to go into the courtroom and prove to the judge, hey, I don't want to pay this loan anymore. That's not how you do it. It's
Right.
not I don't want to pay it. I can no longer afford
Right.
to pay it. Okay,
Right.
so they got to prove that. Well, we've already given them this low custom term loan. How are you going to prove you can no longer afford that? Something must have changed
Right.
significantly. Well,
and
now
if you have a co-borrower, it has to apply to them too.
yeah, mom and dad have to bankrupt too. Grandma
Right.
and grandpa. This is not a you get out and they get out. No, you both have to do it.
Mm-hmm.
So what we do to protect our investors is we're always pushing up that co-borrower rate. We want to do that. And we want to keep that balance low, okay, that $40,000 average, which is actually the average in the industry. But you do that and you're going to reduce the risk of a borrower taking bankruptcy in the event laws were to change.
Yeah, I see that. All right, Lane, how could an investor screw this up?
How can
What's the risk? What's the downside?
how can an investor screw it up? Interesting question. I don't know how an investor can screw it up. You know,
We understand if a borrower doesn't pay, we all get what happens there.
Yeah, the investors are in the portfolio, so you're
Right.
not tied to any one loan. You're in the whole
Right.
portfolio.
Okay.
And as I indicated earlier, our default rate is exceptionally low.
Right.
So, an investor, frankly, the only thing they could really do to screw it up is get in and then decide to get out early, and you wind up surrendering the interest. The penalty for early withdrawal, we didn't really talk much
Yeah,
about
let's
that.
touch on that.
The liquidity feature for an investor is structured similar to a CD. Client needs out, or the investor needs out early. The penalty is interest only.
Okay.
Okay, there's no attack on principal. It's
Okay.
interest only.
So if they get in and they pick this 1 through 5 year time frame,
Right?
and they decide they want to get out and get their money out before that's over,
Right.
they lose the interest.
Correct.
They
No,
get their principal back.
get their principal back. It's a 90-day money out. That's how long we have to do it.
Okay.
Example in the
So
1
within
year.
90 days, they'll
Yeah.
get the money back that they put in.
Exactly. And the best example is, you're in the 1 year, you're in for 6 months, and you want out. Okay, you surrender 6 months interest. If you're in the 5 year, and you're 4.5 years in, don't do that. That's a
Right.
bad call, right?
Right.
That's when I'm going to call you and say, what can we do? How can we figure this out? You're almost at the finish line. We got to
Right.
get you across that finish line.
Right.
You're almost there. I don't want to see you fail, right?
Right.
Now, we're obviously going to do whatever you tell us to do as the investor, but
Right.
let's have a conversation. Maybe we could turn income on, turn it up, whatever we can do to help you get across that finish line.
Right.
Because we don't want to see that, right?
Well, and if you combine this with the personal bank concept, that would give that borrower even more options.
Correct.
Because if you got some positive leverage, you've increased your rate of return, you also got more cash value in your policy,
Right.
that would buy you a lot more options.
Right.
Lane, thank you for joining us today.
My pleasure.
Real quick, how do
Yep.
they contact you for more information?
InvestYREFI.com. It's invest, the letter Y, REFY.com, or call me at 602-292-6287.
Thank you for joining us.
My pleasure.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.